Today's lesson, the basics of preferred stock. Preferred is a different class of stock than common stock, meaning that it has its own unique features. Some features are advantageous and others are disadvantageous in comparison to common stock. Remember that preferred stock is still an equity security, so purchasing this class of stock will still represent ownership in the issuing company. The advantages unique to preferred stock is that they receive a fixed dividend rate, much like how you receive fixed interest in a bond. The fixed dividend rate will be a percentage of par, which is $100 in a preferred share. So for example, a 4% preferred share will be 4% of $100 par. This means that an investor will receive $4 per share that year. Also remember that this is cut into 4 payments of $1 as preferred shares are quarterly distributed. Another advantage would be that any dividends owed to preferred shareholders have priority over common shareholders. To put it simply, preferred shareholders are paid before common stockholders. Preferred stock also has priority at dissolution over common stock, meaning that if any sort of bankruptcy or sale of the company occurred, preferred stockholders will receive any returns before common shareholders. Also, just like common stock, preferred stock has limited liability, meaning that they can only lose up to the capital invested. Unfortunately, preferred stock does not have the same capability for capital appreciation or growth that common stock has. You, as a preferred shareholder, also do not possess voting rights like common stockholders have. Also, just like bonds, which is a fixed income security, preferred shares have an inverse relationship with interest rates. So if interest rates go down, then preferred share prices go up. But if interest rates go up, then preferred share prices go down. Another issue with fixed income securities is that they have inflation risk, also known as purchasing power risk. Since preferred shares provide a fixed dividend, it hurts investors when the price of goods and services rise due to inflation. Always remember, investing in securities isn't about one being better than another. It's about the preference of the investor. An investor that prioritizes growth would go for common stock, whereas an investor that wants steady income would prioritize preferred shares. Once we determine that an investor wants preferred shares, we can dive into more of the specifics of their preferences. That's when we discuss the different types of preferred shares, which we'll talk about in the next video.